Hello, everyone, and welcome back to another issue of Macro Matters, where we talk about the macro issues that matter to the markets, particularly for our CFA Society members and their friends. My name is Rich Excell, a CFA charter holder and member of the Society, and I'm once again joined by my co-host, Tony Zhang, my co-host and colleague. Tony, nice to see you again. Hope you're enjoying the long holiday weekend in Chicago in the U.S.
Yeah, nice to see you again, Rich. Definitely over the past 2 weeks or 3 weeks since our last episode, there were lots of major economic developments ongoing in the world, from which actually have impact not only just within the U.S. but also over some emerging market like China. I guess many investors might be really interested in seeing some of the discussion, or might they wonder it's like whether they should actually consider about balancing off the investments U.S. and also globally. I think this will be a great time for us to actually to discuss about that. And more interestingly, today the Nobel Prize in economics was actually given to three faculties, focusing on the development economies, like Darren S. Mongolo and I think James Robinson
Yeah.
from University of Chicago, and two faculty from the MIT. Actually, they all focus on their theories and research over the development economy. Very fantastic thing about the Nobel Prize this year, and this is to another certain sense. This actually give us maybe a hint where we should actually start to think about the economy is going forward from now on. I think this is a lot of interesting things, developments for us to actually maybe elaborate in this episode, Rich.
Yeah, for sure. And I mean, we both you mentioned James Robinson from the University of Chicago, and also we had a link to the CFA Institute because one of the winners is on the CFA Institute Risk Modeling Committee. So ties to
Exactly.
both the CFA Institute as well as to Chicago. So very timely that that comes up. Um,
I know.
for
Yeah.
yeah, for those that are listening on podcasts, we'll try to walk you through the charts that we're going to look at. If you're viewing on YouTube, you will see the charts, but we will kind of talk through them as we kind of get to them. But to your point, Tony, we wanted to start out by we kind of touched on it last time a little bit. This is just a chart I'm showing of the as a proxy here. This is the FXI performance versus SPY, right? And so we can certainly see that for the better part now of over a decade, the U.S. market has been outperforming the Chinese market, and kind of this trending move lower. So in spite of those large moves, historic moves, really in the short term that we've seen in the Chinese market, it's pretty amazing to see the magnitude of some of the moves at the index level, even in a major economy like China. Yet, if you look at it here at the far right of the screen, all of that is really just a small blip on the radar, suggesting that if there's something very real going on here in terms of stimulus, that there might be a lot more upside, and that's something that investors want to consider because from an allocation perspective, if this just reverts back to any sort of mean over a period of time, there's quite a bit of outperformance possibility. But I guess you're the expert, so I would defer to you. What do you think about how much stimulus we've seen? Have we seen enough stimulus, and is it in the right places?
Yeah, Rich, this is a topic. Whether to invest into China had become one of the most, I think, hottest topics in the investment community here in the U.S. Over the past 2 weeks, and in general speaking, it's like many investors will be extremely cautious to invest into China, even to invest into Chinese ADR, those kind of companies listed to the New York Stock Exchange or Nasdaq here, they were extremely cautious due to the tensions between two major economies in the world. So without actually getting into the political side of that, if we actually just trying to think from the economy perspective here, China and the US will still be the two major economies or economic entities going forward in the next maybe 5 or 10 years, just looking forward. From that perspective, like if we actually really think about from investment, especially from the trade-off of balancing in investing perspective, having exposure globally will always be a case. Why now? And why at this moment is a very, very critical moment. So many people was talking about that. This chart actually is telling a lot, millions of things that a lot of investors wonder. Over the past maybe a decade, we will continue to see is that Chinese stock market, and including the Hong Kong stock market, continuously to underperform the U.S. counterpart here, given right now the major economic growth in the U.S. and also technology innovation in the U.S. Plus, simultaneously, the interest like a difference between two major economies. Here in the U.S., even with the 250 basis point cut, we still have seen the interest rate floating around 4.75% to 5% versus back China roughly about 2 to 2.5%. So we still see the interest like a difference here. Most of the investors, without actually considering about the exchange risk, they will actually think about there will be some risk-free arbitrage opportunity here. Just assuming there will be the capital flow, there will not be any restriction in the capital flow. That being said, investors will borrow the money from China and invest and convert it into the US dollar and invest into the US dollar and put it into the bank and take the 4.75% or 5% of risk-free interest rate and make the interest rate different by assuming the exchange rate does not change dramatically, and which actually turned out to be the case. Over the past decade, even the US Chinese stock market continued to underperform. But if we look at the exchange rate between the Chinese currency versus the US dollar have become relatively stable, right? Very, 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 very stable over the past decade. If we actually bring up, sometimes it could be even just we can actually see the Chinese currency even actually increase or appreciate it. Now here, this is a contradict to many people's belief of why this is the case. Now, over the past decade, Chinese government focused on their economic development by heavily investing to the real estate market, different from the US dollar, like most of our Commonwealth is stored in the stock market compared to the Commonwealth store in China. It's in the real estate market. So this is a fundamentally difference here. But since I think September 18, the moment the Federal Reserve cut 50 basis point here, we have seen the capital just flush it out from the US capital market and other market, including the Indian and Japanese market, into the Chinese stock market or capital market. Simply, really, because from the comparative perspective, if we look at many of the companies' valuation in China, in the Chinese Asia or Chinese stock market Asia over there, like the P multiple is roughly in the single digits, 6 or 7. Compare here is 14 or even like 20, or even like if we're talking about tag, NVIDIA 50, 60. It's really high valuation versus over there.
Yeah.
So from the risk and reward perspective, at this moment, you definitely should think about investing into China, given if you think the stability in investing in China is manageable going forward over the next 5 or 10 years. So the tension between two countries apparently definitely would have some huge impact over psychologically how institutional investors think about here. But last week, Goldman Sachs, JP Morgan, and many people like from institutions in the US already actually recommended to buy into China. Even Goldman issued a report. Why not buy now? Very straightforward. Like David Tapper, like buy everything now on the CNBC. So we can actually start to see this kind of a sentiment shifted like going forward. And this is very, very critical. Many people might be curious, why not? And this actually should be related to our last episode, Rich. In our last episode, both of us, we thought it was a huge surprise that Federal Reserve cut 50 basis points, surprisingly,
Yeah.
given the strong economic growth, the strong corporate earning here, and they leverage maybe some kind of data, the unemployment rate, and the job date market data. They say, hey, we actually right now we focus less on inflation, but simultaneously we focus more on the second mandate, which is to keeping the unemployment rate low here by cutting the 50 basis point to prevent that from happening. But this is a very, very critical development here because both of us thought it was surprised. It's not just from us. If we actually just look at the job data released for September last week, right? The
Yeah.
the job data was extremely good. If I remember correctly, how much like
It was
roughly about yeah
254,000, right?
254,000 versus 140,000
Yeah.
estimated. That actually is telling us the job data is the job market is extremely good. So any like unemployment data that have been released before the Federal Reserve making those kind of decision was actually self-contradictory to the job data report here. We just cannot. This must be some either one data must be either underestimated or it's not correct. So statistically, as what we discussed, right? They might actually
Yeah.
adjust either higher or will be significantly higher or significantly lower. This data is really blow every people's mind. And even I think former Treasury Secretary Larry Summer just called the Federal Reserve like 50 basis point cut is a mistake. And I actually tend to agree with that. This is because if we actually cut the Federal Reserve cut us 50 basis point here, that would actually give the market a signal that was there something wrong with the U.S. economy. If there was something wrong with the U.S. economy, like where the capital should be going, if not in the U.S., then they will
Yeah.
actually look for some where there could be some potential place to park their capital investment. Now, apparently, China at almost historical low valuation point at the moment will attract a lot of investors. That's why we actually saw many the issue I think happening within the U.S. Treasury market, also Indian and Japanese stock market over there. I think this will be an ongoing development, even though there was a retracement in Chinese stock market over the past 1 week. But the things, I think the trend has actually reversed, and this at this particular moment, there's definitely investing into China should be at least something worthy of uh, noticing. That's how I thought, Rich.
Yeah, for sure. And then there's a couple things that I want to touch on. I think we can, we're going to look at the bifurcated U.S. economy a little bit later, maybe looking at large cap versus small cap. But a couple things that I wanted to kind of follow up on and kind of get in there is one of the things I was looking at today, which used to be a pretty good indicator for me when I considered whether or not China would outperform the U.S. or vice versa, was looking at the money supply growth in each of the countries and just trying to ascertain from that. And if I go back 25 years, it has a pretty good fit. Certainly in the last couple of years, it's really been thrown off. Some of that may be because of the rapid increase in money supply in the U.S., which corroborated then with a big time shrink. But as we saw in 2023, China's money supply growth was much more rapid than in the U.S. Like it was it was more than 15% relative growth. And even now, it's this year, it's probably about 6% more growth. And I guess what I was thinking about today when I looked at this was that, of course, we know just from using a simple quantity theory of money that it's not just money growth that matters. It's people's willingness to spend or invest that money that they're getting, right? And we saw that after the financial crisis, where you could create as much money as you wanted. But when consumers and businesses are so shocked from what's been going on in the economy that they're just going to take that money and repair their own balance sheets and not spend it in the economy, then it's difficult for the economy to grow, even when you're throwing a lot of stimulus at it. Post COVID, it was very different in the U.S. because the response was so quick and so large that people took that money and they immediately went out and they spent it or they invested it, and that it led to a V-shaped recovery in the U.S. However, in spite of the very large money supply growth that we, on a relative basis and absolute terms, that we've seen in China, I wonder if consumers and companies are in that mindset much more like after the US financial crisis, where they want to just bunker down and take any of that stimulus and use it to repair their own balance sheets and not do it for kind of pro growth measures. And with a youth unemployment rate, when we look, you say youth, but when we look at people aged 16 to 24, so the young members of the working world, that unemployment rate's around 20% in China, which is can tell you why a lot of students that we have and a lot of their parents are not feeling particularly bullish right now. We
Very
know that
true.
export growth, we saw the export growth data today was much, much less than expected. And China is still an export led economy. And I know it's trying to transition to a domestic led economy, but so companies aren't seeing the export growth that they expected. And there might even get worse if more tariffs come on, into next year. So I can see where people, even though we have all this stimulus on a relative and absolute basis, where there might be some Chinese consumers and Chinese businesses that are thinking to themselves, maybe now is not the best time to be spending or investing money, but instead trying to take any of that excess capital that they get and repair their balance sheets. But
Yeah, Richard, this is a very
yeah,
good point. Very good point. If I can add comments on that,
yeah,
we now saying typically from um, market perspective, from investor perspective, we definitely can see the decoupling between the capital market versus the economy, and this has turned out to be a major case in China over the past decade. That being said, even China continued to grow as the second largest economy in the world, but the performance in the stock market has turned out to be at relatively bottom uh, uh, for investor perspective. Here, with the historically like stimulus that Chinese government has actually pledged over the past 1 week or two, you know, from my point of view, it was like a historical. They actually trying to lay out as much as they could to actually to stimulate the economy, which actually transitioned from a tightening economy policy over the past 5 years to now more of like aggressive or stimulus like economic policy since 2 weeks ago versus. So this is a very, very major shift. This is something that we typically we don't see it. If for anyone or investors that who might be familiar with the Chinese like capital market, they typically would know that Chinese central bank they were very, very cautious actually to allow the banking's like a capital to be directly invested into the stock market. They were very cautious, and on the contrary, in the past they actually prohibited like those kind of a stimulus, like capital, to flow into the Chinese stock market. But this time they set up some tool, just like quite similar to what the central bank at Japan to utilize. They say they even they encourage the bank, mainly the main banks in China, to set up some exchange program so that they can actually take the equity as collateral and then use that collateral to borrow the money from the federal central bank. This is a major shift from policy perspective. We haven't really seen this over the past 2 decades. So now, from the stimulus perspective, over the weekend, they continue to have a different meetings, not only just from the fiscal monetary perspective, they also trying to come up with the meeting the stimulus from the fiscal spending perspective, just like the U.S. Government here. Why did the U.S. stock market continue to outperform so strongly over the past 1 year or two? It actually one of the major components. I think you will agree. It's actually coming from the government spending here by adding the government budget deficit here. This is one of the major like stimulus for
Yeah.
the U.S. market continue to grow. So Chinese government actually is adopting that similar principle here, even though they have to go through some kind of like procedure. They have to go through some legal bureaus to approve, quite like going through the Congress approval process here. Similar thing, I think this stimulus will be extraordinary. And given now what we have seen here, in the Chinese stock market has remained as historical low valuation perspective versus the U.S. stock market has remained to be like relatively high. I would say it's from the valuation point of view, it's not extremely high, but still remain to be high. We definitely see a lot of investment opportunity by thinking about from a risk perspective.
Yeah, I think that that's a great point. And you mentioned the fiscal deficits and the government spending, and I find it kind of ironic that it's easier for the U.S. to spend money fiscally than it is in China, which is a command economy, where versus the U.S. democracy. But we see with executive orders that we can get a lot accomplished, I guess, pretty well.
Yes,
It
yes,
reminds me, Tony, I looked at a few scenarios over the weekend in my blog and said, okay, people want to compare the current situation to a lot of different periods, and of course, a lot of investors are looking at this being a soft landing and comparing what we're going through right now to the mid to late 1990s and suggesting that, in 1995, the central bank cut interest rates and the yield curve never inverted. We never went into a recession. And we know how strong the stock market was in the late 90s. And that's the scenario they're looking at. And interestingly, and especially in relation to Asia, if we think about it, it was in 1994, the U.S. was raising rates pretty aggressively, I think from 3 to 6%, similar to how much actually the U.S. raised them even more in 2022. But back in 94, it was that raising of rates that made U.S. rates or U.S. assets more attractive at the end of it, from all the money that had flown into Asia in the early 90s. And since a lot of that capital was misallocated, as that money came back to the US with these fixed exchange rates, that led to what we know as the Asian financial crisis. And the Fed had to ultimately reverse some of its rate hikes just to accommodate those kind of global problems that we were seeing. But that's the scenario a lot of people are looking at, which is one that's very bullish for stocks, but kind of laying out, one of the other scenarios I looked at, was like the 1970s. And that's a scenario where the Fed, thought they had inflation under control in the late 60s, was getting a lot of political pressure from various leaders. And, we had just come out of the Great Society, the guns and butter of fiscal stimulus in the late 60s, much like we've seen in the COVID time, where we've got guns and butter, if you will, in terms of fiscal stimulus, political pressure to not or to make rates more accommodative for sure, a Fed that was willing to be accommodative because they feared some growth concerns that maybe other people aren't seeing, which sounds kind of similar to what we have right now, and continued rampant fiscal spending into the 70s, which led to a massive reacceleration of inflation as we got from 1972 to 1974 or 5. And that's another, to me, very plausible scenario of what could happen, if the Fed is going to continue easing its policy. It's calling it normalization, but with stocks at all-time highs and credit spreads at all-time lows, it's tough to say that financial conditions are tight right now. Maybe the economy is bifurcated, but that to me is a risk factor that I think a lot of people aren't necessarily considering. And just one last thing before I kind of move on to the other charts is I'm not saying that this is going to be similar to the financial crisis, but it was interesting to me because I thought of that, we had that August de-risking event that we had this year, whether it was the yen carry trade unwind or whether there was something else going on. It was a very rapid and massive de-risking. And then next thing you know, things were kind of moving back to being okay. And that was similar to, if you remember, what we saw in August 2007 when we had the quant meltdown in August 2007. And the quant funds all blew up, and a lot of discretionary managers did pretty well that time. And at the end of it, things were just fine. But the Fed responded by cutting rates 50 basis points in September of 2007, much like they responded by cutting 50 basis points here. And the Fed at that time was getting a lot of criticism for being so responsive in cutting rates. Because if you remember, the ECB, among others, was actually hiking rates in the summer of 2007. And maybe that was because they saw some other concerns in the investment universe because of misallocated capital that could be going on now as well. Again, not suggesting that's a high probability event, but I think to me there are other scenarios besides just the mid 90s um, soft landing and equity reacceleration, which is consensus view that one might want to consider. And along the lines of what you're talking about with the fiscal policy and maybe the Fed moves impacting how others around the world are thinking about rates, I'm bringing up the chart now of just the 10-year U.S. yield, which since that September 18th, almost to the day, I think it was to the day, this after the September 18th rate cut of 50 basis points, that marked the low in the 10-year yield at 3.62. And since that time, they've rallied almost 50 basis points. We're about 4.1%. I mean, the bond market's closed today on Indigenous Peoples Day, but we got a 50 basis point cut from the Fed in September 18th. And since then, the 10-year yield has gone up by 50 basis points. Bonds have gone lower. Maybe you're absolutely right that foreign money is coming out of the US bond market and looking for other places to go with it. Is that something where you think we would see the impact of what you're talking about, of foreigners kind of coming out of the US market in the bond market, maybe even before the other markets?
Yes, Rich, I really appreciate it. You bring this up. And actually, the image that you showed on the previous slide was a great one, a fantastic one. If you don't mind, I don't know whether you will be able to just show up the previous
Oh,
the
this
image
is
of
the
the screen. Yeah,
Chinese stock market.
this is the one. I think this is a awesome one. Just looking at the different time period. Now, if we actually looking at the situation, what had happened over the Chinese stock market just over the past 2 weeks, this is like we definitely saw a huge spike, which actually rallied about 40% to bottom to the top of 1 week time period. This was historical uh, like phenom phenomenon that we haven't really seen for a decade, even in the U.S. stock market as well. Now, if
Yeah,
you don't
40
mind,
for
yeah,
40% move in a week in a the
yes,
largest index in the second largest economy in the world is pretty unheard of for sure.
pretty unheard of. Exactly. That's actually remind us to thinking about what happened in post in the COVID when the actually U.S. stock market started to rally, given the Federal Reserve cut interest rate dramatically to almost zero, which actually stimulates the recovery of the U.S. stock market. So historically unprecedented. However, I also appreciated your point that you brought this up by making some comparisons over the history in the past almost like a 40 years, when this is the period that happened over the past couple of weeks versus in history since like a 1990 to almost the most recent financial crisis. If we actually look at a history, almost every time, I cannot find an exception. Every time since the Federal Reserve started cut the interest rate, there were there was a major crisis. What happened either in the U.S. or in some place in the world?
Yeah.
Back to 1997. Actually, you mentioned about 1995. This is a great thing. When Federal Reserve started to raise the interest rate aggressively, and it started cut in 1997. So we saw the Asian financial crisis, right?
Yeah.
And back to 1999, when actually here back in the US, the Federal Reserve started cutting interest. We saw the dot-com bubble market collapse. In 2007, actually, Federal Reserve also needed, when they started to curb, when they started to curb the inflation dramatically due to like oil and also real estate market in the US. Here, they started cutting in 2007. That we saw the financial crisis back in 2008. And every time, every moment, if you look back, some bad things would happen. This is corroborated as when you brought up the risk. Risk would happen somewhere, somehow. Here, last year, that we saw the Silicon Valley Bank went bankruptcy. And this moment, just think about where this crisis would happen. Something bad would happen. Would this time be exceptional if we actually think about the scenario is either soft landing or no landing or hard landing? Even by presumably assuming that could be the soft landing might be the most ideal cases here, but the crisis would explode somewhere somehow where we don't know. At least people haven't really mentioned about, right? This is something that really concerns me because we have had the 5% rate 5% as the interest rate over the past 2 years within such a short amount of time that we actually start to see some market weakening and weakening. For instance, the commercial real estate here in the US has reached to a tipping point. If we actually continue to hold the interest rate so high, given the strong economic situation and the resilient inflation data here, would that sector be extremely good, or it become some kind of value trap, right?
Yeah.
This is very concerning to me. So, and plus, in addition, in the past, different from historically, either 1997 or either 1999, 2007, what we have, something that we haven't seen in the past is from the globally and also and locally, we haven't really seen the U.S. government is running at such a huge budget deficit, $3.6 trillion, right?
Yeah.
Yes, $3.6 trillion. It's just to making a very simple calculation, multiplied by maybe the risk-free rate, 4.75%. That number by alone, it's actually, every people know, it's much larger than the our defense budget on annual basis, almost like 20 to 30% of the GDP here. Now, this we talk about this in the past couple episodes, how the U.S. government will actually resolve this, or how the U.S. central bank will solve this problem. This has become a huge question mark, certainly for sure. Now here, when we actually start to see the Federal Reserve start to cut the interest rate aggressively. Now the situation will be here, contrary to many investors believe that, oh, we're going to see the appreciation of the U.S. Treasury because interest rate will go down, that the valuation of the price of the bond would actually go up. But instead, now the capital response is to flee away from the U.S. market, not actually stay here to continue to buy the Treasury bond. They actually flee away. They're looking for something, the assets more valuable. Money or capital is smart. This is always smart, always okay. If the capital is not smart, the people behind the capital will be smart. They know exactly what's going on. Okay, so here
Yeah.
is things that we should. I really love the point that you bring up. The risk, I think, is building up here, and it will come out somewhere, someplace, sometime that we don't know. It's completely out of whack here. And given the situation is more complicated, the country is divided. No one wants to actually get into the political side, but the country is divided. And Wall Street is divided. Silicon Valley is divided. How the country will actually unite together to continue to make sure that we are able to pay off the interest and simultaneously growing the economy and making sure that innovation will continue to generate a lot of huge return to the investor. A lot of uncertainty going forward, Rich.
Yep. No, I completely agree with you. And the one thing that the country's not divided on is their willingness to spend money because both candidates seem to want to spend money and grow the deficit even
Yes,
more. So there's at least at least that's a partisan or bipartisan
correct.
effort. Interestingly, we're looking at this Chinese stock market. It bottomed and started to move higher, that 40% historic move on September 18th, which is the same time that the US Treasury yields bottomed and started to move higher on September 18th. And there was a lot of expectation, a lot of hope, if you will, and I'll use hope as an acronym, but that the Fed cutting rates was going to spur the housing market. And I think many that have kind of listened to me and kind of um, you know listen to my stuff, and read my blog, etc., know that I follow this HOPE acronym, which stands for housing, new orders, profits, and employment, because that tends to be how money flows into and out of the economy. And this housing market has stayed stubbornly, very stubborn and not really taken off. We had some signs of optimism last year, but that rolled over at the end of the year. Spring of this year started to look good again, but that's rolled over here. And as the housing market has struggled to get any sort of traction this year, we've seen, I have housing, new orders, profits, and employment on this chart. We've seen new orders here in green continue to roll over and move lower, which is giving some people some and has given people those concerns on growth that maybe after that unemployment number they don't care so much about. But I will tell you that unemployment numbers to me are the most lagging of indicators. And so to me, that doesn't tell me how the economy is going to do next year. It tells me how the economy is done this year, which is in the rearview mirror, and I don't necessarily care so much about that. And you can see the red line here is the actual profits from the S&P, and they've had been kind of moving up on a year-over-year basis, but they're starting to flatten out. The market's expecting them to continue to grow, and we'll look at that in a few more slides. But the expectation is that profits will continue to grow. However, the housing market and the new orders are telling us that maybe profits aren't going to continue to grow. And then what we see here is this unemployment, which had started to turn up. The rate started to turn up a little bit. I have it inverted. Maybe it backed off a little bit, but that is going to start to continue. Employment is lagging, but we will see that happen. But it's really all hinges on the housing market and what that means, and why hasn't the housing market, why hasn't the housing market been better? A couple reasons. One, of course, those mortgage rates, we want to look at them. And mortgage rates had come down in anticipation of the rate cuts too, and they moved higher. But the chart I'm looking at here is not just the mortgage rate, it's the mortgage rate less the treasuries, because we know that banks will hedge themselves with 10-year treasuries when they issue a mortgage. And historically, the spread of the mortgage rate to the 10-year treasury has been around 1.7%, somewhere between 1.5% and 2% in some sort of range, except for in periods where the banks get really stressed, back in the financial crisis, back around COVID, et cetera. And really, over the last couple of years, the banks have still been very stressed about not wanting to make mortgage loans. And we can see that that spread is somewhat persistent around 3% from spread to the 10-year, which is keeping mortgage rates a bit high. And I think some of what's feeding into that is the next chart that I'm going to show you here. Banks know this, consumers know this, we all know this, except for maybe some people in the media that want to use the Fed rate cuts to buy stocks, is that housing affordability, and this data here comes from the National Association of Realtors, housing affordability, which combines mortgage rates, it combines home prices, and it combines incomes, is at the worst in the history of this data. And this looks back 40 years or so, and I imagine if it went back further, it would be even worse. The affordability of housing in the United States is the worst it's ever been. In fact, in every major city that you look at, it is still cheaper to rent than to buy. And it's not saying that that's cheap to rent, it's just saying it's cheaper to rent. And so there really isn't this massive incentive. There's actually a disincentive for people to leave their rental properties and buy homes because homes are frankly just unaffordable. And part of that is the mortgage rates being kept high by banks, et cetera. Part of it is that wages haven't kept up. But a lot of it is that house prices continue to be really, really expensive. And then this is the last chart I want to show you. But this just looked at the median U.S. house price, the U.S. house sales price divided by median incomes. And we can see that this has consistently trended higher. It used to be somewhere around 3 to maybe 3.5% of your income. You would be you 3 to 3.5 times your income is what you'd expect to pay on a house. And I think that was the rule of thumb. I know when I came out of college, and really for the better part of most of the decades that followed, is that people would tell you that if you can buy a house for somewhere around 3 times your income, you're in pretty good shape. And then that's was the rule of thumb, because that's kind of where things settled out. We saw a massive ratchet higher right before the financial crisis, where all of a sudden that went up to 4.5%. It came back to that magic 3.5% after the housing market imploded in the financial crisis. But since then, it's gone up from 3.5%. And at one point in 2022, before the Fed really started to try to slow things down, because of all the demand for housing from millennials that are forming households, et cetera, and because of the lack of inventory, it was 5 times your income you needed to buy a house. Now that's come back a little bit, but it's still well over 4 times your income needed to buy a house. And if you look at where a lot of people have decided they wanted to buy a house, for instance, in Florida, and then we've had the hurricanes that have gone through there. And from what you understand is that it's impossible to get hurricane insurance. Not only are you buying a very unaffordable house, but you're having to insure that yourself, because you can't get the insurance against potential disasters. And we've had back-to-back horrible disasters. And so I look at this and say that the panacea that's expected of the Fed cutting rates, feeding into mortgage rates, feeding into housing, which flows into the economy, might not just be as smooth as everyone thinks it is. And I think that even if it is to an extent where we might start to see mortgages come down, I think you're going to see people spending, and keeping those prices stubbornly high, which is going to keep inflation high, and makes me again think more that the 1970s scenario might be more um, realistic than the 1990s scenario. But I don't know what you're thinking about housing these days, Tony.
Yeah, Rich, I think I agree 100% with you with regard to the complexity within the housing market going forward. Apparently, it's very horrible that we see back to back the disasters happen in North Carolina and Florida. This is also something that we cannot actually control, but this is something that we possibly could do, is how we can actually make some financial, monetary, and fiscal policy that actually would help the people to be more willingness to spend over the economy, and simultaneously will make it the home more affordable. And the housing affordability is a great topic. I think that's also one of the hottest topic between two presidential candidates over the economic policy this year, even though there might be a lot of uh, disagreement in their respective ways. But the one thing for sure is we definitely can make a conclusion. It's become very, very difficult just for younger generation to afford buying a home, buying a house here. Just like many aliens who actually came to this country and then continue to develop their career and raise their family, just like many people. Myself, it's also the case. I actually was inspired to come to the U.S. This is because the one concept called American Dream. Like
Yeah.
many people write American Dream. So what's the definition of American Dream? It's having a home belonging to themselves is one a major component of that, right? Now
Yeah.
here you making the housing affordability is reaching to historical low. Many people fresh graduated out from the college cannot even actually uh, pay off their student loan or student debt. This is making and simultaneously coupling with the inflation in the real estate or housing market. This is making buying a home almost close to impossible. Just average price, housing price since the COVID, since the 2020 COVID has actually grow up almost like a 50% or 40% at least across all of the major metropolitan cities in the US. So, but the income hasn't actually gone up that much for anyone. And now here, with the renovation or innovation of the AI revolution kicking in here, what we are going to see here in the future, we might see the coexistence between human and also AI. That is a double-sided sword. That being said, on one hand, AI can help increase the productivity. On the other hand, AI would definitely replace many of the job opportunities that used to be available for recent graduate or some maybe the newer generation. Given that as a fact, apparently that we have continued to organize many like AI related events or webinar here at CFA Chicago. This is like I would actually encourage you like many audience continue to watch back. This is like our his past webcast related to the AI. But here the fact is how can we actually make the home more affordable given at such kind of high price? Inflation going forward with two presidential candidates willing to continue to actually increase the government's budget deficit will actually remain high. Even though I think the balances like interest rate for central bank has actually raised from 2% to 3%, right? Richard, I think that's the case.
Yeah.
And if they continue to raise the budget deficit, I see no way that the inflation would actually go down dramatically or below 3%. And that would actually make the housing affordability even bigger concern. To a certain extent, I might not actually agree that even set them up to give some kind of a credit for people for first-time home buyer will actually help. Just most likely, it's actually in a good faith to definitely to offer some incentive for the first-time home buyer to help the maybe younger generation to buy a home. But this is it cannot be solved just by actually providing some stimulus. Now here we look at the spread between the mortgage rate versus the 10-year treasury rate here, which actually still very, very high. And I don't see, and it's like, it's still remain very high. So people can argue in two ways. One way to say, okay, it can actually the spread decrease, which actually make the like a housing more affordable. But if that's the case, when that happens, I would anticipate there could be a time we are actually falling into a financial crisis immediately. So that actually might make people losing more jobs. They actually have less jobs going forward. Given simultaneously we see the AI replacement impact over the job market, right? So this is a very, very complicated process. We don't see that this is going forward might be the case. Now, by looking at self-contradictory unemployment data and job data, even in the past 1 month in September, the only explanation will be that when people, especially high paid jobs, people might get laid off, and they have to take 2 or 3 of the job like geek work. They might have to try Uber. They may have to try Uber Eats, something like that. They take those kind of low paid job, but sacrificing the high paying job. This might be only one of the explanations for that. Now, from the younger generation perspective, this is even harder. I think many people might have to actually continue to rent a house, rent an apartment in the major metropolitan city, and how we can actually continue to push forward innovation to create more job opportunity. This requires the bipartisan efforts, which cannot be resolved in a short term, especially given right now like two parties like might have a huge split in terms of physical and even domestical and international policy. It might be very, very difficult. Apparently, in less than 3 weeks, we're going to see the outcome of the presidential election, and this year turned out to be very, very critical year. for the U.S. Almost for every U.S. citizen going forward, the outcome would have a huge impact, and of course, it's going to have a huge impact over the investors and financial capital market here in the U.S. Rich, this is my final thought.
Yeah, no, that's a fair point, and I wonder aloud if instead of giving a credit to home buyers, which is only going to drive prices higher, if they shouldn't give
Yes,
a credit, if they should give a credit to home builders to
yes,
incentivize more supply, which might drive prices lower. But I want we in the interest of time here, I know we're kind of running up against the hour here. We talked, I talked about how housing affects new orders and ultimately profits, and here we are really at the start of earnings season. And I wanted to look at a couple charts of earnings expectations. And we can see for the S&P 500, I've got the chart of the S&P 500 earnings growth expectations. Um, for the next for the next 12 months and then on the years beyond. And you can see that for the S&P, the growth rate expected in earnings is 12% for the coming year, and then 13% for the year after that. When, which is a pretty high growth rate expected, and that's why we look at the forward 12-month estimate, even with that 10% growth rate, is still about a 23 times PE. But, if we look at the small cap stocks, earnings growth is actually for the, earnings growth right now is expected to be for the next 12 months, a negative 8%. So it's actually expected to decline and not grow. Now, the following year sees some explosive growth. Um, but the interesting thing to me is like we talk about this kind of bifurcated economy amongst consumers where some people are doing pretty well and others might be struggling. But you're seeing that among large cap and small cap stocks as well, where the not only is the performance been much stronger for the large cap stocks, but the expectations are much higher for the large cap stocks. And if we look at it, I've got the chart here of the Russell versus the S&P, and it doesn't look very much different than the chart of the FXI versus SPY. As much as the China's been struggling relative to the S&P, the Russell's been struggling versus the S&P, and the last few years is no different. Maybe this is just an S&P phenomenon, but again, going back to my scenarios, if we truly believe in the scenario that the economy is going to have a soft landing and it's going to be fine, and that we're not going to have a lot of job loss, and that the Fed's going to continue to normalize rates, that seems like that would be a scenario that would be really healthy for small cap stocks. However, we're not really seeing that in the expectations that analysts are putting for or for Russell earnings, and we're not really seeing that for the performance of small cap stocks on a relative basis versus large cap stocks. And so maybe I'll give you the last word, Tony. Any thoughts here? I know we're just at the beginnings of earnings season, and next time we meet will be in the middle towards the end, and we can cover earnings a little bit more. But as we're going into earnings, any thoughts on small cap stocks versus large cap stocks and what we might expect?
yes, Richard, this is a very interesting topic as we are running out of time, so I just keep my comments short. Apparently, like the relative performance between the large cap versus like a small cap, I think hinge on the past of the Federal Reserve's interest rate policy going forward. If actually the Federal Reserve cut the interest rate very aggressively, then which definitely would help the small cap outperforming the large cap counterpart. This was the case over the past 1 week, especially since like September 18 when Federal Reserve cut surprisingly 50 basis points. Because this was the case. But here's the situation. Given what we have discussed, this is a lot of risk going forward here. And it could be the situation is when Federal Reserve start to realize there might be some mistake, and I think the Federal Reserve did actually realize that could potentially cause some trouble here because on one hand, you do want to stimulate the economy. On the other hand, you want the capital to remain in the U.S., not fleeing out away, not
Right.
flee away, okay, from the U.S. capital market. This is very important. So they have to manage the expectation. So to manage the interest rate path expectation, that being said, is that we will not cut the interest rate as aggressively as the market would anticipate it. no, we do not have time to actually delve into that. Even the market will actually price in two additional 25 basis point cut in November and in December. If the Federal Reserve does actually cut more aggressive, then surprisingly, that apparently small cap would actually would certainly have a very nice chance to rebound. But here, given the situation, the Federal Reserve actually soften, or they may actually reflect on their decision in September. Now, they could slow down the interest rate cut path going forward. Then in this case, that will actually would help the large cap continue to outperform. So this was the situation in last week. This so this you can see this is a very there are competitive arguments on both sides. On one side is small cap company hasn't really been able to actually start to make money or generating the profit large enough over the next 12 months. And on the other hand, we continue to see the large cap tech consolidated and improve their net margins, net profit margin very healthily, so they can actually navigate the interest rate, high interest rate environment, and still generating the huge profits just because of their network effect, something that unprecedentedly in history overall. Now, the AI innovation or revolution, in another sense, in addition to helping the small cap, but actually on the contrary, would help the large cap tech to consolidate their monopoly positions within the financial market. This is what we have seen here in this case. Given the situation, OpenAI was able to raise almost like a $6 billion, given a 150 billion valuation as one of the historical huge largest unicorn. So this would continue to help the large cap tech situations here from an investment perspective. So we still need to actually balance off the two opportunities and risk on investing into both small cap and large cap. Both have a very strong arguments, and so we'll just see which one would actually continue to develop look going forward. Which is how I think. Yeah.
Yeah, no, you're absolutely right, and I think I think that's going to be the closest thing we want to watch on going forward basis is
Yes.
trying to understand how, if we're going to see mean reversion in this kind of bifurcated economy, bifurcated market that we've seen. If so, if there is mean reversion, there could be some tremendous potential for outperformance from some assets that have been left behind for quite some time. But if we're going to see kind of more of the same and a continuation of these large cap names continuing their outperformance, large cap US names continuing outperformance versus international peers and versus their domestic peers. One just has to ask how much further that can go and what we need to see that going. And I would watch really closely to see, especially as we kind of get out of the election season and move into the spring. I would definitely want to see the housing market start to pick up. Otherwise, I would be a little bit worried about the sustainability of that. But I think on that note, Tony, we've been
Very
about an
agree.
hour,
Yeah.
so maybe we'll leave it there and we'll get together. We'll reconvene to talk about earnings in a couple weeks, and to not only talk about earnings, but to set up a little bit more about what things are looking like right before the election. And
Exactly. It,
that
yes.
should be a good time to catch up.
I highly think so. I really look forward to the next episode.
So thank everyone. Thanks everyone for joining us on Macro Matters, where we talk about the macro that matters, and we look forward to joining you being with you again in another couple of weeks. So thanks again, Tony. Thanks for joining me.
Yeah. Thank you so much. Thank you, everyone.